Short on cash for your school tuition? You might need a student loan. There are three places where you can receive student loans: the federal government, the provincial government, and private institutions such as banks. The federal government is your first and best option for student loans because they're the most flexible, as they offer grants, which are gifts that you do not have to repay, and bursaries, which are income-based gifts, which you also do not have to repay. Also, the federal government offers the best interest rate on your loans. To be eligible to apply for a Canadian government student loan, you must be a Canadian citizen or permanent resident, and you must be taking at least 60% of a full course load if you are a full-time student. If you qualify, you'll receive some paperwork which you'll have to fill out, and then you'll be officially accepted into the student loan program. Now you might be wondering how you'll get your money. Well, the federal government will deposit it directly into your bank account. Also, some schools may request that the government pay them directly. Now, if you still need more money after the federal government loans, you'll need to go to the provincial government, which is the second best place to get a loan because its interest rates are the second lowest. If you still need more money after that, you'll need to go to a private institution such as a bank, which offer the worst interest rates. Now you're done school and it's time to pay off your loans. After school ends, you have a 6-month grace period before you have to start paying off your loans. Most schools will set you on a 10-year plan, making payments to pay off your loan every month for 10 years. Now that's all good, but if you don't pay off your loans, you'll be in a lot of trouble. First of all, the more you don't pay off your loans, the more you'll go into debt. Second of all, your credit score will drop, and you need a credit score to buy a house, a car, almost anything. And if you don't believe me, you can ask Mr. Pegley. And that's not the worst of it. If you don't make a payment for 270 days, you'll go into default. And when you're in default, the government has extraordinary powers of taking your money away from you. There are 3 ways in which the government can get your money. First of all, they can garnish your wages. That means that they take a percentage of your wage, take a percentage of your annual salary. This can be up to 15% of your annual salary. Secondly, they can take your tax returns. Also, if you're married, your spouse might lose their tax returns as well. Thirdly, you could be sued. The moral of the story is, pay your loans. Most students take out a student loan to pay for their school. So if you think you might need a student loan, don't worry, it's a great option. But just remember, someday you'll have to pay it off.
A line of credit is an arrangement where a bank offers a maximum loan amount of credit that the client can use at any time. Unlike a regular loan, you don't start paying interest until you decide to use the credit. You can use as much credit as your limit allows you to and pay back any amount as long as it reaches the minimum monthly repayment set by your lender. A line of credit can come secured or unsecured. Secured is typically backed by the equity of your house. Secured comes with lower interest rates, lower monthly payments, and a higher limit. Secured is the best option if you plan to spend a large amount of credit. Unsecured has faster approvals and less paperwork. However, it's harder to obtain because a good credit score is needed. You're also likely to pay higher interest. Unsecured is often chosen for outstanding payments like purchasing a car, home renovations, or education costs. Each line of credit comes with the limit size. The size can range from $5,000 to $500,000. Your limit depends on many things, like your credit score, your income, whether it's secured or unsecured, and any other financial obligations, such as car payments, mortgage payments, and other loans. Insurance for your line of credit can be purchased so that in case of injury or death, all payments will be suspended. Insurance can be purchased as a percentage of the outstanding balance. Costs will depend on the level of protection and benefits you choose.
Let's talk about a mortgage. A mortgage is a way to use one's real property, like a house or a building, as a guarantee to get money. So it's a loan for the purchase of a real property. To make it work, we need a debtor and a creditor. The debtor is the owner of the property, while the creditor is the owner of the loan. So the debtor gives creditor a house in order to get creditor's money. Mortgage loan is the loan that is secured on the borrower's property, means that a legal mechanism is put in place which allows the lender to take possession and sell the secured property to pay off the loan. Mortgage loans insurance is a protection against mortgage default and enables consumers to purchase homes with a minimum down payment of at 5%. Mortgage default is when someone is not making payment on his or her mortgage and the loan is considered to be in default. CMHC, Canada Mortgage and Housing Corporation, is a country's national housing agency providing mortgage loan insurance, mortgage-backed security, housing policy and programs, and housing research to Canadians. And there's many types of mortgage. The first one is conventional mortgages and high ratio mortgages. For conventional mortgages, you must have at least 25% of the purchase price. Some lenders will require CMHC insurance because of property's location on types. While high ratio mortgages, you only need 5% to 25% of the purchase price, but these have to be insured through CMHC. Open mortgages and closed mortgages. Open mortgages allow you to pay any amount toward your payment at any time. On the other hand, closed mortgages require you to make set payment at set time, cannot be prepaid, renegotiated, or refinanced before maturity. Fixed rate mortgage and variable rate mortgage. So what is mortgage rates? Mortgage rates is simply the rate of interest by a lender. Mortgage rates rise and fall with interest rates and drastically affect the home buyer's market. So the fixed rate mortgage, like the name, its interest rate will not change throughout the entire terms of your mortgage. But variable rate mortgage, the interest rate may fluctuate from time to time. It changes when the mortgage prime rate changes. Thank you.